right, well, welcome everyone to our last installment in this video series, this webinar series. Just a quick audio and visual check. If you could quickly type in a plus or a minus, or if you can hear us, perfect. All right, excellent. All right, good. Well, thank you so much, guys. Hope everyone's doing well. Let's kind of go through a little bit of the motions and talk about, well, first of all, let me talk about the topic for today. Once again, this is now the third and final installment that's been a little bit of a mini series within this series, where we're talking about daily market, the daily market checklist, and real-time analysis of the market. So that's what we're going to do here in today's session. If you guys have questions, of course, as always, feel free to answer those. To ask those, I'll get to those right away. But I do want to kind of sum up and to go through the most important points that we have highlighted over the course of the past, it's been past 2.5 months now, I think, or more, almost 3 months of doing this series. I feel like this has been very focused that many of you are starting to understand the beauty of trading stocks, U.S. stocks, what that means from both the liquidity perspective, from an opportunity perspective. So let me just for the next 5 minutes or so take a bit of a step back and kind of review again the key points. So number one, we started off the video series talking about the importance of having a market that if you're going to trade, of having a market that first and foremost is very liquid, okay, and really closely followed by that is it has to be a market that is well controlled, that is fair to trade. That's really important as well. You don't want to be trading a market that where the odds are against you, simply because it's being manipulated too much. So those are really, really important things. And then the third point I'd like to make, and I know I've said this a lot over the past 16, 17 webinars here, but the last point really has to do with understanding the importance of having a market that has a defined time frame within which it actually is open each day. We talked about this as being something that a lot of people tout when they want to trade currencies. A lot of people think that's an advantage, that currencies are basically open around the clock 24 hours a day. And why I don't want to say that's necessarily a disadvantage. It is certainly, I think, makes it more difficult for people to be successful trading currencies unless they have a very specific time of day when they know there is a high probability trade to do. But if you're simply going to trade in the markets just because or whenever you have time, that's not the right way to look at the market, in my firm opinion, of doing this for nearly 20 years, because the market is not going to wait for you to have time. Rather, you need to find and operate in the market when there are good opportunities, and those opportunities will be different each day. If you're a day trader, they'll be different each month. If you are a swing trader, and so on and so forth. So having a very defined open and closed period each day for the stock market, for the U.S. stock market, the European stock market, for stock markets around the world, I think is actually something that helps people have some structure in their day and in their trading, as opposed to markets that are open 24 hours, just because it gives them a little bit more, it's a little bit more defined of when they can actually trade in the market. So also what I'd like to do now is I'd like to go through and today spend a lot of time analyzing the current market. Now, before we do that, let me just be very clear about that. Even though I'll be doing a current market analysis of where the market currently is, this the point of the webinars is for them to be evergreen, so that they can always be used as important education tool. And so just because now I'm going to go through and I'm going to analyze the market that's currently here as I'm recording this today, doesn't mean that you can't learn from it. The point isn't here necessarily to give you buy or sell ideas. The point is to go through and to show you, what I've developed over the past 20 years as an approach to trading the markets, and that has worked very well for me over time. Also, one more thing I want to make clear before we get started is this whole notion of day trading versus swing trading. Now, we talked about this throughout the webinar, throughout the series, and while I think there are certainly viable opportunities out there to day trade, day trading really has to be approached through in a way that very much focuses on a specific setup each day, as opposed to at a certain time most of the time. And so I just want to make sure that people understand that there's an alternative way out there of making money, which is really what practice and preach, which really is more of a swing trading approach. And that approach focuses on finding opportunities in the market where you'll then do a trade. You'll stay in those positions for anywhere from a couple of days to a few weeks, to maybe as much as a few months, and you start taking profits along the way. You maybe trade around those positions, which is just another way of saying that you might have a core long position and then do something with that trade around it. Maybe you take some profits, maybe you buy more at a dip, and so on and so forth. So those are just the different opportunities. All right, so that's kind of what I want to go through, just the most important points. Again, trading stocks, trading U.S. stocks is really my focal point. I have found that this is a high probability part of the market to focus on. Personally, I do think trading commodities is very, 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 very difficult. Particularly gold and oil are very difficult markets to trade for the most part. Again, I'm not saying impossible, because I think that's just that would be an ignorant thing to say, but I do think they're challenging, certainly in relative terms, by my experience, versus the stock market. And again, when we talk about the stock market, I think the best opportunities in the stock market lie within within the large and mid cap stocks. Yes, there are small cap stocks out there that one can trade. And I know some people, find success in that. I do find that those stocks, from a swing trading perspective, tend to be very unpredictable. So which is why really my focus here is much more on a swing trading perspective, which, by the way, you can do whether you have a job, part-time job, full-time job, whether you are maybe you're retired or semi-retired, maybe you're a mother or a stay-at-home father. I have clients in my Clubhouse membership and my students that are, it really runs the gamut, if you will. In other words, there's any type of people. I have people that are, again, like I said, retirees. I have students. I have mothers. I have, most people have some sort of a job, part-time, full-time job. I have a lot of people that have jobs that give them some time each day where they have time to look at the market, a little bit more so, more free time than others may have, which is, like professions like pilots or doctors to some extent, dentists. I have a whole bunch for some reason. I have a lot of professional athletes, actually, believe it or not, professional athletes playing anything from baseball to golf. So, really, there's anything and everything, and those people find time to, trade stocks, make some additional money on the side. Some of them over time have turned this into their main profession. So that's really my goal, is to teach people that there is a way out there where you can have a wonderful lifestyle to trade the markets, from an active investing perspective. You don't have to be stuck in front of your computer for 8 hours a day. I don't think that's healthy nor smart to be a trader. So keep in mind, if a lot of people have this wrong sort of picture of what I believe, which is that trading is something where you have to be in front of your computer the whole day and analyze things the whole day. And I really don't think that's the way to go about it. I think if you think about it, if you might see videos or movies like Wall Street or something like that, and you see these people on a hectic trading floor. Well, those hectic trading floors, those are people taking orders. They are not actually there trading on their own account. They are taking orders from many, many different people, selling them stuff. So they're busy selling. They're not busy trading, for one account most of the time, right? So if you go to any respectable hedge fund, you will see it's very calm. It's much more calm. There's nothing hectic going on for the most part at those places. So there's that illusion out there that I think has to be clarified, and that's really that's really what I'm trying to teach as well, that trading isn't or shouldn't be hectic, in my opinion, but rather something that's orderly and calm, because only then will you be in a position to actually profit in the market over the long term. Because if you constantly are there to chase every single stock higher or lower every single day, or every currency, I believe that's a very difficult proposal to make money in the market over time. So anyway, so let's look at a couple of things here, guys. I want to, I guess, primarily talk a little bit about the stock market here at the very moment. And if you remember, of course, yesterday, for those of you who may or may not be familiar with it, we had an important speech given by the new U.S. president yesterday in front of Congress. It was essentially also what sometimes one would consider the State of the Union address to the nation. And as you can see, looking at the S&P 500 here, we are breaking to new highs. We're up about 1.2% here right now on the S&P 500 for the day, and that of course already comes on the back of a very steep rally over the past 3 months since the election results. And as much as we continuously have to respect that trend, and that's been my message, if you might recall, throughout the past few months as we've done this webinar series. As much as we have to respect that, and that's the primary message, is to try not to fight trends, but at the same time, we also need to make sure that we take profits along the way. So we're going to do our analysis here. We're going to look at the market here in just a minute to see what's leading and what's lagging this market today. But I guess I want to also give you a quick risk management exercise today, or I guess lesson, for lack of a better term, which is to say that if you have been buying stocks here for the past few months, and again, this is kind of an evergreen statement. Yes, I have to, of course, talk about the current stock market here as I'm recording this, but this holds true in any market. A lot of people will always try to fight the trend, and if your primary objective is to make money in the market, which it should be, although you'd be surprised how many people actually are in the market just for entertainment, which is rather sad in my opinion. If you are doing if you are trying to primarily make money in the market, make sure you stay with the trend. That really is a very, very important thing, and it's actually something that I feel that I would like to touch on a little bit more here today before we finish off the webinar series. And there are some very simple mechanisms by which you can judge whether a market remains in a trend in different perspectives. So let me just give me one quick second. I have to trade something here on the settings, and I'll be back. Just give me one quick second. Okay, so what I would like to primarily show you guys here is my moving averages, and first and foremost, I want you to see the lines here. We start with the black one, which is my 21-day simple moving average, and then right after that, what you'll see is the yellow line, which is the 50-day moving average, and actually, let me check. I need to check something here on the settings. Okay. There we go. All right. So the next one is the 50-day moving average. Then we have the blue line, which is the 100-day moving average. And lastly, we have the red one, which is the 200-day moving average. Now, this is something that we've talked about a lot in this webinar series, and that is basically that we want to use moving averages. And this, by the way, applies to both. This applies to any asset class, right? You want to use moving averages more as reference points, as opposed to as exact points in time where you need to buy or sell any given asset, if that makes sense. So, for example, if we look at this this chart here of the S&P 500, you can see that we have held above that 20-day moving average or 21-day moving average. Doesn't matter; it's almost the same. The black line, pretty much ever since breaking above it here at this point in time, which happens to be when the U.S. election results came out, right? So, you want to respect that as a trend, and you want to respect the underlying price action there mostly for perspective. So, if we then take this analysis a little bit further, you can also see that the 50-day moving average has been holding as support, and so on and so forth. So, from a trending perspective, you can see that all these moving averages are trending higher. So really, from an intermediate term perspective, there really is no reason, in my opinion, to be sort of shorting or fighting the trend, the underlying trend in higher in an index like this. So I see a lot of people, and I know a lot of people, unfortunately, that have not been trusting this rally to the upside, and despite the fact that that it's been very clear, right? Because they had some sort of an opinion, right? They had an opinion on the stock market, they had an opinion on maybe a political opinion on the new presidency or whatever it might be, and those are just opinions. And the problem is that opinions over time, particularly from a trading perspective, are going to be very difficult, or over time will tend to hurt you more than they do you good. So that's why we have to continuously primarily respect the major trend in the markets, which at this point in time, as you can see, at least for the S&P 500 here, is to the upside. Okay. Now, we're also important through the lens of this risk management lesson that I'm trying to perform here is the very important point of taking profits along the way. Okay, I know I've talked about this in the past in this webinar series, but I feel like it's something that needs further clarification because it is so important. So it's important to understand that just because a market is trending higher doesn't mean you just have to stay long or buy more or or just blindly be bullish, without any risk, without any risk management in place. So I think it's very important to when we have a market like this to respect the trend, but also respect that you have to take profits along the way, because let's be honest, you just don't know when the market starts to correct the next time, or at least starts to pull back some, so that you'll be forced to take some profits. Okay, so that's number one here. I want to just kind of go through this and understand that you have to take profits along the way, because if you take profits along the way, not only do you give you a better chance from a reward to risk perspective to make money, but also you actually sort of rewarding yourself by having made the correct call to buy or sell something, right? If you don't do that, ultimately, one of the worst things you can do is to let's say buy a stock here, and then it goes all the way up where you thought it would go, and then you don't take profits, and then it goes all the way back down. That is really, really bad psychologically to people, because it basically destroys their confidence, and that's one of the worst things that can happen is that your confidence gets destroyed. All right, so I just wanted to make that point, because I think that's a very, very important point from risk management, because at the end of the day, as much as we want to make as much money as possible, it's also important that we take profits along the way. And with that, let's have a look and start analyzing this market here for today. So if we go through our ETFs, our sector ETFs that I've posted here the last webinar, just have a quick look, and you can see that right now the Russell 2000s today is looking very good. Is in fact up almost 2%, outperforming the S&P 500, which is up 1.23%. So if we have a quick look at the Russell 2000, you can see that we are noting what I would say is a quite bullish move from the perspective that we're further breaking out, and you can see once again we're holding above the 50-day moving average and the 21-day moving average. If we look at the S&P 500, the picture is a little bit more vertical, and that's why I actually think the S&P 500 here doesn't offer as good reward to risk. But most importantly to me, and this is something I feel like I should make more clear, because I don't think I've made this clear enough over time throughout this webinar series. To me, most importantly from a sector perspective, is looking at the financial stocks, and that's the XLF ETF. Okay, so if we look at the XLF ETF, you can see, and by the way, I will quickly make this a little bit larger. This is the RSI. All right, you can see we're once again getting closer to that 80 area, and I do think we're ultimately going to be quite exhausted here at the upside. But the financial stocks are very, very, very important. Okay, so now when we look at the financial stocks, I think it's absolutely imperative to then very quickly look at what interest rates are doing. So for interest rates, we can look at something like the TBT exchange traded fund, which basically represents bond yields. Okay, so it's long-term bond yields. So we're looking at 20+ year U.S. Treasury security yields. And actually, let me check if the TNX is available on this platform. No, it's not. Okay. Right, as opposed to the TLT ETF, which I would urge you to write down, which is basically representing bond prices in price terms, as opposed to in yield. Of course, yield and price move inversely to one another. Okay, so let's actually do a little bit of an analysis, and it doesn't matter whether we look at TLT or we look at TBT, but just for argument's sake, let's look at TBT and kind of realize where we might be. I've talked about this for the most part of the past 3 months, and what I see here is a continuing
basically consolidation phase here in bond prices, which looks something like this. And we are seeing today bond yields, this is yields, starting to move higher and potentially start breaking out, which is also not surprising then why we would see the financial stocks, the XLF, start to have such a big move higher. You can see the XLF today is up nearly 2%, which if we look at something like Bank of America, which is part of that group, Bank of America is up, you can see 3%, you know, very, very strong moves here for the banking stocks, which I think are looking increasingly tired. So the point, I guess the main point I'm trying to make here before we look a little bit deeper is that the financial stocks and interest rates are extremely important. It's very difficult to see the US stock market rally over time if the financial stocks don't participate. Okay, so let me say that one more time. It's very difficult to see the US stock market continue to rally over time if the financial stocks don't participate, or at least don't participate to some extent, right? In other words, if the financial stocks, banking stocks like Bank of America and others, if they drop, it's very difficult for the US stock markets to continue pushing higher over time. And you know, I'm not entirely sure what the reason is for that, you know, in the sense beyond the simple fact that the financial sector is very, very important. Okay, but that's kind of a main thing to keep in mind, and that's one of the major things that I've learned over time, you know, in the market over the past nearly 20 years, is the importance of the financial sector, and the importance of the financial sector doesn't really go away, you know. So let's have a look at Bank of America here, and I'll quickly, you know, look at it and kind of show you how I look at the stock right now from a very basic technical perspective. And again, we're looking at the market here at this current point in time, but I want you to understand that this is not an analysis. This is an analysis that the process of which you can apply at any given point. So I look at the stock and I see, you know, a market that's been trending higher ever since this point down here, and you can see, in my opinion, we're getting very, very stretched here, reaching the upper end of this sort of line of resistance, if you will. From a momentum perspective, we're getting quite overbought as well. But again, you know, this is sort of the dichotomy that we always see. You know, we've had this very strong move higher over the past few months, and as much as there's been an opportunity to get skeptical about it, the fact is that we've remained to push higher over time, and that's just a fact, right? We can't argue that, and we don't want to argue that. We want to respect that for the most part. Okay, so let's have a look at a couple other things. One of the sectors that I highlighted I believe last week on Friday, is the transportation stocks, and what I talked about last Friday is, you know, we had actually seen some relative weakness in transportation stocks versus the broader stock market last week, but then very quickly, today is Wednesday, right? So Wednesday, Tuesday, Monday. So last Friday, you can see we had this day right here where my cursor is right now. And at the time, you can see the stock market, their transportation stocks, after just a couple of days of pushing lower, they then quickly give us a bullish reversal on Friday, and then on Monday followed through with more buying. So the transportation stocks too are looking really good. In fact, one stock of the transportation stocks to me that looks very interesting right now, and I actually received a buy signal in it just a couple of days ago, is the price of UPS, United Parcel Service. You may have seen this company delivering packages, or maybe they've even delivered a package to you over the time. But this is a stock that has been underperforming. So let's kind of go through a little bit of the step-by-step analysis of how I came to this stock. Well, number one, I do have my indicator, and my indicator gave me a signal a couple of days ago. It popped up on a watch list that UPS is giving us what I call a bullish reversal. Okay, and that bullish reversal in UPS then actually led me to look at the transportation stocks a little bit more. Of course, I was aware of the transportation stocks and what they had been doing. We talked about it last week. And again, like I said just a minute ago, the transportation stocks had essentially tried to push lower last week, but then quickly this push lower was quickly stopped, and we saw the transportation stocks start to gain ground again. And this is sort of the area of support here, depending on how closely you want to draw these. You know, again, trading is much more an art than a science. But I do want to show you that we've had support. We pushed past what used to be resistance here, basically in November and December of last year. We pushed back above those highs from, I guess this was 2000 and I don't know what year was that, 2011 and 12, right? Is what it looks like. So the transportation stocks are, in my opinion, just now extending to the upside. So given that backdrop in transportation stocks, looking at various transportation stocks, like for example, I like to look at the railroad companies, which is in this case one of them that I like to look at is CSX, and this is a stock that you can see is actually today also trying to attempt to break higher out of what has been a very orderly trading channel, right? So this looks good. We had an up gap here take place after the company reported earnings earlier this year, and now it looks like we want to break that stock higher. Then we look at just kind of a number of different transportation stocks, and again, what I'm trying to show you that there is a process involved in looking for opportunities in the stock market. It's not a random fumbling around the market. You have to find opportunities in a processed place. In other words, processed within a process that is repeatable. And this is a process that's very repeatable. So the number one thing that we want to look at for that process, and the first thing is to look at what the sectors are doing any given day or week, right? And today, the fact that we have the transportation stocks leading and financial stocks being very strong, or actually leading, transport's strong, and the Russell 2000 strong. That's a risk, what we call a risk on day. Okay, so now I showed you a couple of these transportation stocks that are looking quite strong, right? We can even look at maybe see ticker symbol R. Looks interesting as well. Again, these are all different transportation stocks that are embedded or are I should say holdings of the IYT ETF. Okay, so Rider Systems here is looking very good as well, but we'll look at UPS here now in just a second. So let's have a look at UPS, and United Parcel Service has, as you can see, doesn't look anything like some of these other transportation stocks that we just looked at, and the main reason for that is because UPS has, after its earnings report here just a number of weeks ago, had a very big sell-off. In fact, it was a 2-day steep sell-off, and then after that, well, I guess yeah, two big days, and then a little day sell-off, and then it started to sort of catch itself and started going sideways. But the transportation stocks are giving us a really good opportunity here to find opportunities in what might be sort of almost like a value play, if you will, with the stock like UPS. So I look at UPS here, and usually there's basically two ways of looking for opportunities at any given day. Let's say you look for a strong sector, like today you're looking at the transportation sector. You can either look for the strongest stocks within this sector, or at least stocks that are increasingly showing relative strength, or you can look for stocks that have been underperforming in the sector and do a potential trade there. I'll tell you that on average, I will prefer to buy stocks that are showing us relative strength and have tight patterns. So, looking at something like CSX, like we looked at just a couple minutes ago, to me is actually more attractive over time to find opportunities. However, I do respect, if there is a strong enough bullish reversal in a stock that has been underperforming, such as today, UPS is doing that, and you can see it's breaking back above that black line, which is our first reference point. That's the 21-day moving average, breaking back above there, and that's an important signal and something that I want to respect. So you might be asking yourself, what then, if these are the at least two potential possibilities, two ways of looking at the market, what's the better trade? And to be honest with you, I can't tell you, because it really depends on each setup. Again, for me personally, I like to prefer to look at some of those tight setups that I just showed you there a minute ago, like CSX. But at the same time, I also want to respect strong bullish reversals, because it's one of the main things that we've talked about over the past 2.5, 3 months here in this webinar series is the potential for strong bullish reversals to really make you a lot of money over time. Because when you have a stock that is either oversold for fundamental reasons, or maybe it was just an overreaction to a news event, which I suspect is kind of what UPS is here, with a 2-day very sharp sell-off after earnings, as the company gave a little bit more muted guidance, if I recall correctly. Those are opportunities that, if we see a strong enough bullish reversal, and we may be seeing the initial makings of one here, those are opportunities that can really make you money over time as well. Okay, so now again, today we see a strong bullish reversal in transportation, or we see strong performance, I should say, in transportation stocks. We see the Russell leading. We see the financial stocks doing very well. Let's have a look at where technology stocks are trading. And if you might recall, I have been voicing this for the past couple of weeks, that I think that transportation stocks are increasingly overbought through the intermediate term lens. And one of the reasons why I said that is because you can tell a lot by just watching, and the orderly incline which we have seen here in transportation stocks basically over the past couple of months has been just a little bit too orderly. Okay, and mostly what I'm talking about here is this streak of up days here in the stock. And now you can see we may be getting what I could consider a near to intermediate term blow off top here, very much like we saw here. You can see a very orderly incline, and then finally we rallied one more time, and then really, in this case, the stock, the tech stocks didn't correct very dramatically, but they did lose steam and just basically started trotting sideways. Right, which brings me to another important point, since this is our last webinar in the series, unless we come to an agreement and add more, and that is really this whole understanding that a stock, when it's overbought or oversold, it doesn't have to correct up or down. It can also correct sideways, which is exactly this example that I'm giving you here, right? So just because there was a very strong rally here in the technology stocks doesn't mean that they have to correct lower, right? They can also just work off those overbought readings in time, which is sort of the way we refer to it at least in my world, right? So right now, if we were to apply the same analysis to the current market, is it possible that the technology stocks here could ultimately start, correcting lower 5 or 10%? Of course, and that wouldn't be, and that is not at all a big deal. But it doesn't have to be that way. It's entirely feasible for the market to continue to basically push sideways, okay, and work off those overbought readings in that manner. Okay, so now I'd like to take the last 10 minutes of this webinar for some stocks, some tickers that you may want to look at specifically. One of the stocks that we just mentioned here is UPS. So if you guys have other stocks you want to look at, I'd be happy to look at them. One logical ticker here that comes to mind would be Apple, because Apple very much reflects this price action in the technology stocks. And I look at Apple here, and this is something we've talked about for the past few weeks as well. We said that I think on a sustainable basis, it's very, very difficult to imagine that Apple will ultimately be able to hold above these highs here after having traveled so far over the past couple of months. And I still think, that's very much true here. So I'm actually looking for Apple to potentially start retracing a little bit here in the not too distant future. All right. And Apple, of course, is very important, and an important stock, not just for the technology sector, but also for the broader stock market in general, right? All right, so one stock here that's coming up is Alibaba. Let's have a quick look at Alibaba, and it's actually a stock I just looked at this morning, and you can see, in my opinion, the stock is very much like a lot of things, basically stuck in this range. Now we're seeing the stock market, broadly speaking, release to the upside, but I do think this is a stock that could ultimately start breaking above the $105 area, which would be right about at the upper end of this range, and then possibly start moving towards 110, 115 dollars or so. So that's one stock that I'm looking at here right now. And again, I don't want to make this too much of a. I do want to keep this a fairly evergreen webinar recording. So it's important to understand that what we're looking at here is after a big consolidation period like this. Technically speaking, the market can go in either direction. It can break higher, or it can break lower. And in this case, you can see that we have these intermediate term moving averages and the near term ones here, the black line, the blue line, the yellow line, and the red line. They're all pointing to the upside. So it's entirely possible that this market ultimately starts breaking lower, but the path of least resistance, even just from a moving average perspective, does look to be to the upside. If you take, for example, here, we can apply the same here. You can see that here Alibaba started pushing higher, and then ultimately it started breaking below support. But then very quickly, within the next sort of couple of weeks or so, these moving averages also started to roll over, and the 21 days started pushing below the 50-day moving averages, and then the downside really started to roll. So again, we don't want to fight trends. We want to primarily respect trends, because fighting trends is something that not only is it very frustrating, it is, of course, ultimately also something that can be very, very costly. Okay, so if there's nothing else that you're going to take away from this, this is certainly probably the number one thing that I can tell you to take away. All right, let's look at Archer Daniels Midland, and here we have a stock that is very much looks like a lot of the rest of the market. It's been basically consolidating for the past couple of months. It had a bit of an initial rally after the election. Even though it hasn't made new highs, it's constructively positioned, right? You can see, just applying the same analysis, the medium-term moving averages are all pointing higher. We've got a stock that is attempting to break past these highs over here from last. I guess that was last November, and all in all, this is not something that, in my opinion, you want to fight on the downside, right? It's probably something that one wants to respect. And ultimately, if we can maybe break above $47 and change, maybe a little bit higher, then that's probably something where I'd look to participate on the long side, as opposed to trying to fight it, right? If there's nothing else you're going to learn from this, this is probably the most important thing, is to make sure you don't fight trends. All right, so now let's maybe use the last 5 minutes or so to talk about something important. So what would be my sort of recommendations for further knowledge in the stock market? Ebooks, websites, blogs, and so on and so forth. Well, obviously, I'm going to tell you to look at my own courses, which cover a lot of the intermediate to advanced topics when it comes to trading stocks. So you can go to thestudytrader.com, thestudytrader.com. So that's THE study, STEADY, trader, TRADR.com. You can also probably just put my name into Google. I type in my name, Serge Berger, into Google, and you'll probably find my website there very quickly. So I have a lot of courses. We do a lot of webinars in my membership as well. So, and this is, it sounds a bit of like a shameless plug for my service, but if you're asking me how can you learn more, that is certainly, obviously, where I have put my heart and soul into. So you get daily videos with I have a subscription service as well, and different courses and all that kind of stuff. Otherwise, one thing we've talked about is in terms of getting information. I think marketwatch.com is a good website to look for opportunities. So let me just quickly show you. And again, I'm not representing any of these companies or anything like that. But marketwatch.com I think is a good website. Obviously, Bloomberg.com is a good website. Here you find, not only do you find a lot of data under markets, but also actually a lot of good columns, a lot of good perspective. And yeah, that's kind of how what I look at. In terms of the platform, I do honestly think this platform here, Roboforex one, is very, very good. It's very robust. It's very straightforward. There's a lot of stuff out there that's still a lot of websites out there, a lot of brokers that are not easy to use. This is a very easy and straightforward to use platform. So I would certainly recommend that you give this a bit of a try. Okay. Let's just look at a couple more things. I wanted to also just have a look at shares of Facebook for you. Okay. And again, going with this theme of playing stocks in trends, I think it's very important to, again, primarily respect the trend that we are in. So in this case right now, that means that for Facebook, the trend obviously is to the upside, and we want to respect that. We don't want to fight that. There are easier ways to make money. There are other ways. If you want to just waste money, there's other ways of doing that. But I truly think that fighting the trend in market is probably one of the more frustrating things that one can do. So I would certainly refer you to a trend following approach more than anything else. Again, we have the same lesson here in Facebook that we talked about before. If you look at Facebook here through a multi-year lens, you can see that the stock started to show us some weakness here in the October-November period of last year. You can see very clearly the near-term moving averages started breaking lower, and then finally, once we started, getting an initial reaction here into early this year, you can start to see that again the near-term moving average started pushing back above the medium-term moving averages. And again, what's important here, I think also, and I'll make this my very last point here before wrapping up the series and today's webinar, is that a lot of people talk about these moving average crossover moves, and while I think they're interesting to note, to me it's also very important that you understand that these crossovers and moving averages are really just to be used for reference points, very much like
moving averages themselves are best to be used for reference points, and as opposed to absolute buy or sell signals. So just because this moving average crossed above, the black one crossed above the other color moving average doesn't mean it's automatically a buy signal. It just means that it's a reference point and something that you want to keep in mind. So keep in mind also, from a technical perspective, the more things come together, the more of different parameters come together, whether it's a moving average or a trend line or a Fibonacci support level or a what else could it be? An oversold momentum. The more of those types of things that come together, the better your odds ultimately are of a successful trade. In this case, to the upside, or of course the inverse would be true to the downside. So, a lot of people, when they start trading, and it doesn't matter which asset class they're looking at, they for some reason believe that all they need is one indicator to tell them exactly where to buy and where to sell. And again, the market is not a science. The market is very much an art, and that's exactly why we have to piece together information every single day using this sort of multi-confluence type of approach. So that's what I wanted to go through today. I certainly hope this webinar today has been helpful. I hope that the series has been helpful. If you guys have feedback, I would urge you to give it to our friends at Roboforex. I wish you guys all the best in your trading endeavors. And if you guys, again, if you have questions, and by the way, I would love to hear more from you. If you guys want to send me an email, you can just go to my website, and I would love to entertain you there more in your further education there as well. So that's it, guys. Thank you so much. If you have any last questions, I'm happy to take them right now. But otherwise, we'll wrap up the series here. Again, it's been a great pleasure. I hope this has been insightful for you. Again, the U.S. stock market and stocks in general are a great asset class to trade. I would encourage everyone to try the stock market. It is a market that is, I think, somewhat more straightforward to understand than other markets out there. Specifically, if you can focus on companies that you can understand. Yeah, that's kind of what I would say. So anyway, guys, thank you so much, and best of luck out there. Take care.